Welcome back to Investing Talk Podcast. Today we're putting a spotlight on a company that, well, it touches so many of our daily lives, Dollar General. We're going to unpack their upcoming earnings report and really dig into what to watch for. Our mission, as always, is to sift through the data, articles, and research you've provided, extracting the most important nuggets of knowledge and insight so you can quickly get well informed. Before we jump into Dollar General's numbers, though, if you're finding value in these discussions, please take a moment to subscribe, like this content, and maybe leave a comment below. It truly helps us reach more curious minds like yours. And if you're feeling extra supportive, consider buying us a coffee. The link's below. Also, if there's a specific company you'd like us to look into, let us know in the comments. We genuinely love hearing your suggestions. So for this particular focus, we've gathered quite a bit of material on Dollar General. Let's set the stage. When exactly is this report coming out? And what are analysts collectively expecting from them this quarter?
Absolutely. So Dollar General is set to report its earnings on August 28th, 2025. That's right before the market opens. Now, when we look at the analyst consensus expectations for this quarter, the revenue estimate is sitting at approximately $10.3 billion. And for earnings per share, or EPS, the consensus ranges from about $1.55 to $1.57 per share. What's really striking here, though, is that this EPS range represents a year-over-year decline of roughly 8% to 9%.
Wow, 8% to 9%. That's pretty significant.
It is, especially for a company often seen as quite resilient, right? It signals that analysts are bracing for some, fundamental headwinds to profitability.
An anticipated drop like that,
Yeah.
it certainly catches your eye. Is this just a blip, maybe? Or does it signal something more fundamental about how they're handling inflation versus competitors? Maybe a new ceiling on their margins?
That's a crucial question. And what's interesting is that there isn't really a widely circulated whisper number for this report.
No whisper number.
Yeah. Normally that's an unofficial expectation, often higher or lower, that floats around among traders. Suggests strong conviction one way or another. The fact that it's absent here, well, it implies less speculative betting and maybe more reliance on the official published estimates.
Okay.
It suggests a kind of broad alignment on the cautious outlook rather than, hidden surprises being priced in by the pros.
Got it. And how does that analyst caution compare to Dollar General's own guidance for the full fiscal year? Because sometimes the quarterly numbers don't tell the whole story, right?
Exactly. And if we connect this to the bigger picture, Dollar General previously guided for a full fiscal year 2025 EPS in the range of $5.20 to $5.88, with revenues between, $42.1 billion and $42.5 billion. Now, this is actually modestly ahead of the current full-year consensus.
Oh, interesting. So the company's view is a bit more optimistic than the streets.
Precisely. It's a fascinating disconnect. It raises an important question. Why is the market, or at least analysts, being more conservative about the current quarter than the company itself seems to be about its full-year outlook?
Right.
It implies either analysts think the company's full-year guidance is maybe a bit rosy, or perhaps they anticipate performance might pick up significantly in the later quarters, making this upcoming report a potential low point.
Okay, so that adds another layer. Let's maybe unpack Dollar General's past performance then, to give us some context. How have they typically fared against analyst expectations in recent quarters? And importantly, how did the stock react? Because understanding history can offer clues.
Yeah, looking back, the last 4 quarters, Dollar General has definitely had a mixed bag. It really adds to the uncertainty around this upcoming report. For instance, back in June 2025, they actually beat estimates quite solidly, reported a $1.78 EPS against a $1.48 estimate. So that was a positive surprise.
Okay, a beat there.
But then you go back to March 2025, they missed expectations. Came in with $1.74 EPS versus $1.83 estimated. And similarly, December 2024 saw another miss, $1.19 versus $1.26. But then September 2024 was a beat, $2.47 versus $2.13.
Huh. So, yeah, pretty inconsistent. Beat, miss, miss, beat.
Exactly. It's been swinging back and forth.
That's quite a swing from quarter to quarter.
Yeah.
What did that inconsistency mean for the stock price reaction after these reports? Because a beat or miss doesn't always translate predictably, does it?
No, it doesn't. And the stock price has really bounced around after these past reports. We've seen huge swings on both good and bad news, which tells us the market pays very close attention to what Dollar General says. We saw some pretty severe downward gaps on guidance misses back in late 2024. Those were quite impactful for shareholders. Suggests when they miss, the market punishes them significantly.
Penalties, yeah.
On the flip side, that most recent beat in June It led to a moderate post-earnings rally, but even then that gain was partially faded intraday.
So the enthusiasm cooled off a bit during the day.
It did, possibly due to broader market conditions or maybe some underlying concerns that just lingered despite the beat.
Okay. Beyond the headline EPS and revenue, what about the key operational metrics? What trends stand out in their recent performance? What should we be looking at for their actual business health?
Yeah, good question. A key takeaway here is same-store sales, comps. Sales from stores open for a certain period, they've shown consistent growth.
That's positive.
Right, like a 2.4% increase in the last quarter. So that indicates continued, albeit moderate, demand at existing locations. Good sign for customer traffic. However, gross margin performance, that's varied, largely due to higher input and labor costs. The price of goods, shipping, employee wages.
The usual suspects squeezing margins.
Exactly. Those expenses have been pressuring their profitability. But it is worth noting operating income did rise by 5.5% last quarter, so they're showing some efficiency improvements elsewhere. Overall, sales growth remains in the mid-single digits, which is respectable. But yeah, it's partially offset by those ongoing expense pressures eating into margins. It's a constant balancing act for them.
Got it. So that's the history and recent trends. What about the immediate past quarter? What specific events or headwinds did Dollar General face that could impact these upcoming numbers? And what's a broader economic picture they're dealing with right now?
Well, this past quarter, Dollar General seems to have largely stuck to its established playbook. There haven't been any major new product launches that would dramatically shift their sales profile. Operations have really focused on their, aggressive store network expansion. They're still opening a significant number of new stores, mostly in rural and underserved areas, trying to bring those low-cost options to more communities.
Still pushing growth through new stores.
Yeah, alongside that, they've been implementing, modest cost control initiatives, trying to optimize the supply chain, manage inventory, find efficiencies to offset those rising costs we just talked about. We also haven't seen any disruptive leadership changes or major regulatory headlines. Seems like a focus on steady management execution rather than big splashy shifts.
Okay, steady as she goes operationally. What of the macro environment?
Right. From a broader sector and macro perspective, discounters like Dollar General are generally experiencing steady demand. This is largely because low to mid-income consumers are still feeling pressured by stubborn inflation. That actually supports Dollar General sales as people seek out value, try to stretch their budgets.
Makes sense. People trade down or focus on essentials.
Exactly. Think about your own shopping lately, right? Are you still splurging or prioritizing essentials and looking for deals? That shift across millions of households, that's what Dollar General is navigating. But those rising wage and freight costs, they remain a significant margin headwind for the company.
Still a challenge.
Definitely. And while, moderating inflation might offer some relief eventually, consumer sentiment is still quite fragile. People are cautious, they'll pull back if things tighten further. The retail sector overall has been mixed, but consumer staples, which Dollar General largely falls under, generally outperform cyclicals in these uncertain conditions as people prioritize necessities.
Okay, so a tough environment, but maybe one where Dollar General's model has some inherent resilience. Given all that, how are analysts currently viewing the company? Has their commentary shifted lately?
Yeah, looking at analyst sentiment, it has definitely shifted somewhat. Recent commentary includes some downgrades, a more cautious tone overall. They're specifically citing those margin risks we discussed and the potential for a weaker than expected discretionary spending, even among their core customers.
So worries about margins and spending power.
Right. Some analysts have lowered their price targets or reiterated hold classifications. They're anticipating continued margin compression and pretty muted near-term growth. It indicates a general shift towards a more conservative view of the company's immediate future. Kind of aligns with those lower EPS estimates we talked about earlier. They're really highlighting the challenge of turning revenue into profit right now.
Okay, so the analysts are cautious. Before we get into potential outcomes of the report itself, what's the market's current feeling about the stock? How has it been trading leading up to this report? And what can the options market tell us about expected volatility?
In terms of the pre-earnings price action, the shares have been trading mostly sideways, maybe slightly lower.
Sideways. Okay.
Yeah, it reflects those tempered expectations and just a general low conviction among investors, it seems. There hasn't been a sustained run-up like you might see with high hopes, nor an aggressive sell-off, suggesting no major negative news leak or anticipation.
Just kind of waiting.
Pretty much. Just a relatively tight trading range, a wait-and-see approach. Now, if we look at the options market, Like the call and put ratio, the open interest is fairly balanced, maybe a slight tilt towards puts.
Puts suggesting some hedging.
Yeah, exactly. Suggests some market hedging ahead of the event, people buying protection against potential downside, which is actually pretty typical for a value retailer before earnings, given the uncertainty around cost pressures. As for implied volatility, the options market is suggesting a potential move for the stock, plus or minus, of about 7% to 8% following the earnings report.
7 to 8% move implied. How does that compare?
It's a modest elevation compared to the stock's historic average move. So the market expects a noticeable reaction, but maybe not an extreme, outsized one. It's a way for options traders to play that expected swing up or down.
Okay, so the stage is set. Analyst caution, sideways trading, moderate volatility expected. What does this all mean for what might actually happen when the report drops? Let's break down the potential outcomes. What would signal a bullish surprise and what points to a bearish one? What should our listener really watch for?
Okay, for a bullish case, right. What we'd be looking for is stronger than expected customer traffic, translating into resilient consumer demand. That would ideally result in a revenue and EPS beat compared to those lowered expectations. Ideally, you'd also see guidance for the rest of the year reaffirmed, or maybe even raised slightly. And crucially, signs that margin pressures were less severe than feared, may be due to successful cost containment.
Specific numbers.
Yeah, specifically, same-store sales growth exceeding, say, 2.5% would be a strong positive signal. Shows robust demand at existing stores, and any clear signs of input inflation moderating would be a huge relief for their gross margins. That combo tells you the core business is healthy and they're managing costs well.
Got it. And on the flip side, the bearish case.
Conversely, a bearish case would involve weakness in guidance, or maybe disappointing EPS and revenue numbers versus consensus, particularly if gross margins shrink materially because of those ongoing cost pressures. Commentary suggesting continued severe headwinds with no relief in sight from input or labor costs. That would be bad. Or if same-store sales slow down to below, say, 2%, that would be concerning.
And a lowered outlook.
Absolutely. A lowered full-year outlook or clear evidence of further drag from broader macro weakness, like a big dip in consumer spending indicators, that would fit the bearish scenario. It would suggest the fundamental challenges are getting worse, not better.
That lays out the scenarios really clearly. Given all those moving parts, comps, margins, guidance, macro, what's truly critical to watch within the report itself, where should our listener focus their attention first?
Yeah, the critical points to really unpack are same-store sales, the comps, and the gross margin trend. Those are the two big ones. These figures will indicate both current demand resilience, are people still shopping there, and the health of the company's cost structure. How efficiently are they turning those sales into profit?
Comps and margins. Got it.
If comps are strong, demand is holding up. If margins are better than expected, they're managing costs. Those are really the key pieces of the puzzle for this report.
Okay, so if we pull all these threads together now, the history, the macro environment, the market's current sentiment, those key watch factors, what's our overall read on Dollar General heading into this earnings report? What's the leaning?
You know, our overall leaning is pretty neutral. The risk-reward doesn't appear strongly skewed either bullish or bearish right now. Expectations have been reset to a degree, especially with that cautious analyst talk and the anticipated EPS decline. But those macroeconomic risks persist, and the cost headwinds are very real.
So balance risks.
Yeah. On a confidence scale, maybe 1 to 10, we'd probably place it at about a 5.5. Kind of right down the middle. But while our leaning is neutral, the key insight here for listeners might not be inaction, but maybe calculated opportunity.
How so?
Well, when expectations are this low and a defensive name like Dollar General is just trading sideways, even a slight positive surprise, maybe better cost control commentary, a flicker of improving consumer sentiment could trigger an outsized positive reaction precisely because the market isn't pricing in much good news.
Ah, the low bar effect.
Exactly. And remember, Dollar General is typically considered a defensive name. It often performs relatively well even during downturns because its products are essentials, low-cost staples.
Right, people still need paper towels.
Precisely. People need groceries, cleaning supplies, regardless of the economy. And they often turn to discounters like DG when money is tight. That provides a baseline demand that can cushion the stock during rough patches.
That's a really important perspective, how lower expectations themselves can create opportunity, especially for a defensive stock. So for our listener, if they're processing this information for their own portfolio, what are some strategic takeaways or considerations, maybe depending on their personal risk tolerance?
Yeah, that leads us to consider your options, the listener. For risk-averse investors, the general advice might be to avoid holding common stock right through the earnings event. It's often wiser to wait, see the results, let the dust settle, and then deploy capital post-report.
Wait for confirmation.
Right. Now, for risk-tolerant investors, maybe considering option strategies like a straddle or a strangle could be interesting. These are basically bets on volatility itself. You profit if the stock makes a significant move either up or down after the report. You don't need to predict the direction perfectly.
Playing the expected move.
Exactly. It's a way to capitalize on that implied 7% to 8% expected swing we talked about, acknowledging the market expects movement, but not necessarily which way. And lastly, for directional traders, those wanting to bet up or down, it's probably best to only take a view if you have strong conviction on those comps or margin trends we highlighted. Or if you see a clear signal from pre-earnings price action or maybe some guidance previews, those are rare. Basically, don't trade just for the sake of trading.
That brings a lot of clarity to the picture and the potential approaches. This has been a really comprehensive exploration of Dollar General's upcoming earnings. It really shows how much insight we can gain by methodically going through the sources and connecting those dots. And as you, our listener, reflect on this, maybe consider this question. How might the ongoing shifts in consumer spending habits, particularly among low to mid-income households, continue to shape the strategies and performance of discount retailers like Dollar General in the long term, beyond just this next quarter? Are we seeing a permanent shift in how people shop, or is this just a temporary reaction to inflation that might fade? Something to think about. Thank you for joining us on this insightful journey today. We look forward to our next exploration with you.